Here we are in Ways and Means. Today is April 15th, tax day to all who celebrate. It's 2:20. I'm gonna make the joke all day. Fortunately, this might be the last time we go live. Guys, it's just, take it while you can get it. Okay, so we shifted the schedule slightly so that we can do the fiscal note from 9:55 now, and then we're gonna go back to our committee bill to hear from Jake Feld from the tax department. And then tomorrow, we're going to go back to our committee bill about the income taxes. And then at 11, we're going to go to any amendments to 9:55. So we are on 9:55 now, fiscal note with Julia. Floor is yours.
Thank you. Julia Richter, JFO. The fiscal note may be posted on the committee page, is posted on the committee page under my name. Thank you. And I will go ahead and share my screen. So this was published earlier this week. We worked on it over the weekend, which is why you did not have it on Friday. I know I'm presenting it, but it was really a team effort from multiple people in the office, so they deserve just as much credit, especially Ezra and Ted. So do you want me to walk through the fiscal note in its entirety, or do you want to start big picture and then we can take it from there?
Let's start big picture. I think we're pretty familiar with the bill.
So yes, so you're very familiar with the bill. I'm not going to do a bill summary unless that's helpful. I'll focus really on the fiscal impact. Big picture, as you all know, as we spoke about throughout the session thus far, the overall fiscal impact of the bill is unclear, as impacts depend on outstanding policy decisions at both the state and local levels. We have sort of in the background and detail section of the fiscal note, we've outlined most of the sections in the bill and talked about potential fiscal implications within each section. I will note the one specific fiscal impact related to FY27 relates to the appropriations. This was voted out of appropriations yesterday with no changes to this. So the bill would appropriate $75,000 from the general fund to JFO for the pre-K study, as you'll recall. This is the House bill, the House budget, as it was voted out, had about $130,000 on the bottom line. So this can be absorbed within the unobligated funds from the House budget. And it also shifts or amends the uses of the Act 73 appropriation and dedicates those funds to the different grant programs established in the bill related to the CSAs and the city committees. So this table here really just captures how the different amounts have been funded through existing appropriations. So you'll recall that this is included in the big bill, and this is really saying of that money that was amended in the big bill in section C103, how are the uses changed? And there's also still $60,000 from the Ed Fund that was related to the BOCES bill. There were those BOCES startup grants, but because there's only one BOCES that was formed, there's still a remaining sum of $60,000 that would be making up part of that $90,000. And then the one appropriation. So I really defer to you all in terms of how I can be of help with the fiscal note.
I know that sort of a lot of the big picture questions you can't model out as a feature. I think we're all pretty familiar with the appropriations in it. So I would just say, does anyone have any questions?
I mean, I thought it would be helpful if you could just review some of the outstanding policy decisions that are going to, I'm not saying what you think either way, but what are the decisions that are upcoming that may or may not impact the fiscal impacts of this bill?
Absolutely. So I would say all of the funding decisions related to school construction, related to transportation, all of the rulemaking pieces, the definition of small and sparse by necessity. I'm really talking off the top of my head. We can also go through, we've outlined some of them. How CSAs result in efficiencies or additional costs. If there are efficiencies or costs gained from the study committees and if they result in mergers. Just trying to think through some of these here. Of course, pre-K and how pre-K is financed. Data collection, if more, so there is the student profile form and also the collection of data from students who receive tuition. So if that is capturing more students than are currently counted in our current state under the current funding formula, that would be shifting tax capacity. Under the future state, that would be assigning more dollars to those students, all else equal. A lot of these reflect, or some of these reflect how school districts or schools will respond. So for instance, with the tuition fee prohibition, if that results in schools increasing their tuition because they can no longer charge for that topping off, that of course, and it doesn't decrease the number of students, that of course would increase costs to the ed fund. I don't know. That will happen. We spoke about small and sparse rulemaking, AOE and state board. Yes, so dependent on the reserve guidance, depended on policy decisions around transportation, regional assessment districts. If regional assessment districts increase the frequency of reappraisals, additional costs may occur. If they increase efficiency, costs may decrease. There's also the payment, the state payment of full reappraisals. That's that lesser of test, right? It's the $66 per parcel or the commissioner's estimate of the full reappraisal, whichever is less. And we know that this would be staggered over 6 years. We know it'd be ongoing. And for context, in FY27, there are 340,280 parcels. So that multiplied by 66 gets you to 22.5 million over 6 years. The property tax classifications, we don't know how, we don't have the data yet, right? So we don't know how the grand list is going to shake out. One of that big outstanding policy decisions there are the tax rate multipliers. With respect to school construction, so there are outstanding policy and funding decisions. This would be related to general obligation, debt service, as well as how that may impact the cash fund, and additional funding streams for school construction if they will be realized. Costs associated with the AOE school construction division is an outstanding question. I'm really trying to hit some of the highlights. This is not exhaustive. This is me talking off the top of my head. The legacy debt aid program. This is that where it's 100% categorical aid for debt incurred prior to December 31, 2025. We know that currently exists in school district budgets. So one of the big outstanding decisions is what is the funding source of that? If it is education fund, it will be neutral, right? Because those costs already exist within the education fund. It's moving into a new financing system. If the funding stream is not, if the funding source is not the education fund, but a different fund, then it would be an increased obligation on that fund and a decreased obligation on the ed fund.
On the legacy debt though, if it's coming out of the ed fund, but we're somehow absolving the districts of having to raise that through additional taxes, wouldn't it decrease the revenue that's going into the ed fund?
No, because if we move away from the district level and we look at it at the state level, I think the point that you're making, which is a really interesting one, is if we were to not be moving to a totally new financing system and this legacy debt aid program were to exist in our current financing structure, it would be shifting the tax burden of districts. But because at the same time that this is going into effect, we're getting rid of those locally adjusted property tax rates. Taxes are going to be shifting anyways, so we can't attribute this to that.
Sorry.
Oh, it's a great question.
I think I should just ask me the exact same question, so thank you.
One of the things I love about transitions and hate about transitions is all the mistakes and dead animals come to the surface every time you do it. Are there other things that in your review of the finance and the structure that we ought to be paying attention to next year or anticipating?
I'm not ready to speak to that today. I will say that we staff have an ongoing document of just technical pieces that are on and policy choices that are on our radar as if this were to come into effect, what are the different pieces? I would be happy to come back when I've had some more time to prepare and talk about that.
It's like that.
Very-
Yeah, comments like that make me so impressed with our staff, Madam Chair.
Yeah.
Very forward-looking and very cautious. I appreciate that.
Thank you.
Thank you, Julia. No one has any other questions? Okay, thanks.
Great.
So we're gonna put away 9:55 for the day. We're gonna go back to our committee bill about income taxes. Tomorrow, we're gonna pick that committee bill up again, and then we're gonna go back to 9:55. If anyone wants to open the third window, they are very welcome to. Okay. The middle guy. Okay, Jake, the floor is yours whenever you want to join us. And we just got our first, we just had our first conversation about the bill this morning, so we are learning with you.
Yeah, I was Jake Feldman, Tax Department. I was watching on YouTube. And Herbie and Pat did great. I think that my presentation is gonna complement it to a large extent. So let's see, I'm gonna share my screen. And I think Sorsha put a PDF of this on under my name on the website.
Representative Odie, do you have a spot while Jake is bringing up his presentation?
I was thinking about the past and Jake, and I was thinking at some point, you probably made some comments about quantifying how much we do for older Vermonters. And I don't know that, did you ever put a study together about that?
I don't think so. Do you mean like in terms of like tax credits and
All things.
yeah, I don't know of a study we've done on that. Maybe that would be in the 10-year. Not sure.
Floor is yours.
Okay, great. Glad to be here talking about income taxes. Maybe this is going to be a little bit less complicated than the second homes tax stuff. I have basically kind of three main things to talk about. The first one is sort of related. I think it's important to talk about because there's some confusing information out there. But I want to talk about who is benefiting from the tax changes and the one big OBBBA or HR1 or whatever you call it, the recent federal tax reform. And Pat did a nice job graphically with the second thing, and I want to show some numbers about how much does a high income filer pay in Vermont right now, and compared to what they pay in another state, and how much would they pay under the proposal. And I want to talk about the wealth proceeds or investment proceeds tax and what types of income would be taxed. So yeah, that's the plan. Okay. This can be, the information I'm about to tell you is like a little bit different than I think what a lot of us are hearing. Maybe even in my own Facebook feed, I'm hearing some different stuff than this. But generally, this is very important. The OBBBA, what it did is it extended some tax cuts that were passed in 2017 in the first Trump administration. In the first Trump administration, they passed this bill, which lowered all the marginal rates and did a whole bunch of other things. And at that time, high income filers got a pretty big break. That was set to expire in 2025. The OBBA said, nope, we're going to keep going with this. So that when you hear, and I'm hearing it too in my Facebook, that high income Vermonters are getting 60,000 or 50, whatever thousand off. They're not. What's happening is they're paying about the same as they have been paying for the past 8 years. And 2026 is going to be just the same. The 60,000 or whatever the number is that we're all hearing, what that is if the tax cuts in the TCJA had been allowed to expire, their taxes would have gone up. But those tax cuts weren't allowed to expire, they were extended, so it's kind of business as usual. So that's an important point. And most of the things in the OBBBA actually were targeted towards lower and middle income people.
Most of the personal income tax.
Personal income, yep. And then on corporate, there's more complicated things that you guys have heard about, obviously. But on personal income, there's no tax on tips. We all heard a lot about that. It's for people with AGI up to 150,000 if they're single, or 300,000 if they're married. And then there's a phase out, meaning the benefit is, diminished as income increases. There's a new deduction on overtime with the same thresholds, and then it phases out. There's a new sort of odd auto loan interest deduction with slightly lower thresholds. They tried to kind of exempt Social Security, but they couldn't really figure out how to do it. So what they did was they made a bigger standard deduction for seniors. It's like an extra $6,000, I believe. And that is for people with income up, single people up to 75 or 150 if they're married, that phases out. There's a child independent care credit, which is going to flow through to Vermont and cost us an extra $1 million. Pat has a great graph on what they did there. But that basically increases how much credit how much of your expenses are eligible. And it helps if you're single and your AGI is under 100, or if you're married and AGI is under 150. And then this one goes a little higher. They did increase the state and local tax deduction for people who itemize their deductions. It was increased from 10 to 40,000. It helps you if your modified AGI is up to 500,000, and then it phases out at over the next 100,000 of income. So if you're making $1 million a year of income in Vermont, this one provision doesn't help you because you're beyond the phase out slope. And then there's some changes to charitable contributions, which there's actually what I think is a really great change, where if you don't itemize, you can now take some charitable contributions, which Vermont does and has been doing since 2018. And then for filers who do itemize, it's got a little bit tighter, so it wasn't an expansion. But really important, I'll say it just one more time, is that there's no personal income tax cut for high income Vermonters in this federal bill. When they passed the TCJA in 2017, Vermont responded, and Vermont raised taxes on high income people at that time. I could get into that if you want me to, but it happened 8 years ago. And so that is kind of what Julie would call a level setting on this one.
Could you just focus on that for a second?
Sure.
Thanks. In 2018, that's when we decoupled from taxable income at the federal level to adjusted gross income and set our tax brackets on that. So because before, the marginal tax rate based on taxable income was higher. And so it dropped to 8.75, but on a bigger number on the adjusted gross income. I remember the positioning that had, and it was positive, but it actually might have been a higher tax rate, is what I just heard you say.
Yeah, we actually had 5 brackets,
Yeah.
back in 2017 and prior, and we collapsed the top 2. I think the highest was 8.95, maybe, and then the top 2 were collapsed. And so it was, the top one, new one was 8.75, but it started at a lower spot. And then also Vermont at that time got rid of itemized deductions, turned charitable contributions into a credit, and capped how much you could take on charitable contributions and some other things. That the net effect was, it made our overall system more progressive, and it was a increase on high income Vermonters.
So the fact remains, though, that if the OBBA had not passed, those 2017 tax cuts to the wealthiest would have expired. And in this current year, they would have owed more in tax than they now have to pay.
That is true.
Right, so regardless, because of this bill, the wealthiest Vermonters are still paying less in federal tax than they would have had this bill not passed.
That's a good way of saying that.
So whether we call it a cut or not is kind of semantic. Because at the end of the day, this bill is allowing those folks to pay less in tax. While I know this isn't part of the tax thing, while working class folks are losing healthcare subsidies and access to food assistance and challenges to life. So
Right.
those folks at the top are getting a tax break while our most vulnerable neighbors are struggling with food on the table.
Yeah, they're getting a tax rate compared to if the tax cuts have been allowed to expire. But I think like the perception that I'm getting from what I see in the news is like millionaire person goes to file their 2025 taxes, and all of a sudden it's like $60,000 less than they thought it would be. And I just want to say that that's not what's happening.
So they're paying $60,000 on average less than they would have had this bill passed.
Yes, but they're not paying 60,000 less than the year before.
Thank you.
Yeah.
Okay, we both established the way we see the,
I didn't realize that.
thank you.
Great, that's the hardest slide, maybe. Okay, so this is putting some numbers to Pat's excellent graphs. I built out a TY20 tax year 2026 income tax calculator that can tell you what some of these taxes would be in any state. It's kind of like a widget. I can send it to you. It's fun. But anyway, if you make $1 million, right now in Vermont, you pay 79,000, which is like 6th highest. And basically, and under the proposal, we would be number 1. And that's the part of the bill with a 13.3% new highest top marginal rate. I can't account for all the weird personal exemption, standard deduction. What if somebody does this or that? I can't do that. So it's really only looking at the marginal rates, and it's assuming they're married filing joint. If you make 10 million, Vermont would be number 1 there too. But I want to point out kind of at the bottom of that, and this is another important point. If you make 10 million bucks, you are paying more in Vermont right now than Massachusetts. And Massachusetts just did a millionaire's tax a few years ago, right?
I mean, they also have like a very complicated constitutional system that keeps their income taxes very constrained.
What's that?
They have a very complicated constitutional provision that keeps their taxes very constrained.
For income taxes?
Income taxes.
Yeah.
So the millionaire's tax they passed was a constitutional amendment because they have a flat tax.
Right, so yes, so they had 5% flat tax, and then they got citizens something or other to make it jump to 9% of the $1 million. And so people say like, well, Massachusetts just did that, right? So Vermont can do the same. My point is Vermont's taxes for somebody making $10 million are already higher than Massachusetts. And that's because their 9% doesn't start till over $1 million income, whereas our 8.75 starts at 312. Do a little math and imagine 2 lines going out on a graph, and you'd have to get to about $11 million of income for them to cross each other. Here are top marginal rates by state. California is currently number one at 13.3%. I think this maybe the bill is like intentionally trying to be the same, but it would make Vermont the same as California, but our starting point would be quite a bit lower. Okay, so that's like, I think that's everything I have to say about the income tax. New bracket.
Any other questions for Jake about the income tax?
I would just say that, ITEP has some data, and I think I'm hearing.
They are coming in tomorrow.
Right, they have some data that shows that the wealthiest folks did get an extended tax break. That even had, with the OBBA, they don't have to pay that tax because those things were extended. Even on top of that, ITEP has data that shows that they're still paying additional less tax than they had to. So just, you might want to pay attention tomorrow to some of what they might present.
Yeah, there are provisions that do help them federally, like the qualified small business stock. And probably some other things that really aren't on my radar. But yeah, I believe that.
In that, how many tax filers in Vermont qualify at the 586 and above? Do you know?
Well, the 586 corresponds to our top 1%. Is that what you need?
Yeah, but how many people is that?
It's about 3,300 filers. Yeah. And I will say that, I know you have Crystal Ball Young coming in tomorrow from Cornell. And so it's like, the question is, well, what's the risk of all this? What if Vermont is number one? And the risk is, potentially a few people leaving, handful, not a lot. Few people will actually pack up their stuff and go to New Hampshire or Florida, change residency. But what's really important is that I hope the committee can accept. When you tax something more, you get less of it. If you tax vape pens for smoking, you get less vape pens. If you tax it more. If you tax second homes more, you get less second homes. If you tax carbon more, you get less carbon. If you tax income more, you get less.
No one's talking about taxing carbon.
They used to, but if you tax income more, you get less income. And I know you heard yesterday about how to set up a trust in another state to avoid income taxes. So what people will do is they will take measures to pay less in income taxes. Do you follow baseball? There's a baseball player named Shohei Ohtani on the Dodgers.
Yeah.
He's really good. He makes 70 million a year. It's all deferred until he basically retires, at which point he may live in Luxembourg
Is
or
that true for all of those contracts?
no.
He just has like a special weird deal?
Have a Bonnie Bonina day.
Do they like have to put it in like escrow or something? Like, how does he even know that like they'll still? I don't know.
Honor it?
Yeah.
I'm
I'm
not sure.
sorry, that was so distracted of me.
No, it's fine.
I'm apologizing to myself, actually.
Thank you,
Maybe
yeah.
I'm not apologizing to Jake. Jim.
Yeah, thank you. I've lost track in New Hampshire, but New Hampshire a few years ago had a dividends tax. It was actually fairly substantial. At one point, it started with basically zero and phased that. And do you know where where those taxes are in New Hampshire
I think it was interest and dividends. And I
that's right.
think they got rid of it.
Yeah,
Yeah.
they phased it out, so it
They don't even phase things in New Hampshire, they just.
It's true.
well, at one point, the comparison was really striking. It was, but if they phased it out, it's gone, okay, New Hampshire figured out some other way.
Yeah. But I mean, like, suppose you have like the Shohei Ohtani of orthopedic surgeons at UVMMC. He's great at fixing torn ACLs. And perhaps if the taxes went way up, he would decide, I don't want to work in Vermont. I'm taking home now 5% less of what I used to, and he may go somewhere else. And then the poor UVMC team who tears their knees up, they get less good surgery.
Jake.
Yeah.
I've actually been really worried about that too, because specialists, when they go to other states, they have a bigger number of doctors in the specialty, then they can take off more time. It's a more humane way of living. Where we don't have as many patients and it's hard to draw people here, and then they draw the doctors here in specialties. And then they have to work a lot more hours because there aren't as many in their practice, which still have a population. So that said, do we know of those 3,300 filers, how many of them are doctors and specialties? I mean, can we look and see that granularly to see who will be impacting and then go from there?
That would be fascinating. On your federal return, you actually have to list your occupation. It's not binding for anything. It's just like, I don't know if you ever noticed it when you're doing your taxes, but I don't know if we get that, but I would like to look at that. But related to your point and also Rep. Kimball's, so there's 3,300 in the top 1%. But in Vermont, it's not the same people year to year. So maybe there is an orthopedic surgeon who makes whatever, $800,000 a year. But generally in Vermont, high income is a one-time event. And in fact, for people who make over $1 million a year, only like 10% of them do it every year. It's usually a one-time event. And we covered that in the 10-year tax study last time. I think we'll look at it again this summer too.
Just, Representative Ansel used to refer to this as bumping. You know, it went up and down. It was sure enough,
What I found really interesting about this last chart we looked at this morning was knowing that it's sort of different people, that people move above and below the line.
Right.
And knowing how much, like how sort of consistent a lot of the numbers in there were. That surprised me, given that like it is a fairly volatile tax type and the last 5 years have been a hail ride.
Yeah, the last 4 or 5 years, personal income taxes have been great. And that's what,
Obviously, the economy is not going in the same direction now that it was.
right.
Yes.
But I bring that up because Vermont, we have data, we know that during the pandemic, some high income people moved into the state. And I worry that if they were able to move here during the pandemic to decide that they're going to live at their ski house or whatever, do they have more flexibility to move back to wherever they came from? Like Massachusetts has lots of embedded industries, I think, that where someone can make a lot of money. I don't know what the embedded industries in Vermont really are. So that's a worry.
Jen, another thing, as a lister, and I think it's even in the lister handbook, it goes back to the early 1800s. It was a faculty tax. It taxed the doctors and lawyers and all that. And when that was repealed in 1850, it's like. But that was another example of taxing and special assessment on professional skills and income.
Well, I read this paper that I think Deb Brighton recommended when I first joined the committee, or maybe, I don't remember what it was. It was just sort of like the history of Vermont taxation. Very interesting. I will go dig it up and send it around to people. But it sort of talks about how like really we started with like taxing sheep. And then some people had essentially wealth that was not represented by tangible objects like sheep. And we moved more towards land and income. And sort of that, what you're describing is like really the first foray into an income tax in New England.
I used to tax clocks and everything.
Mhm. Yeah. Any show of wealth, right? And we've really moved away from those taxing of sort of wealth to the earned income. And more than just doctors and lawyers, but factory workers, yeah.
Little anecdote, there's a chart on the wall at Deptford Town Hall that shows everybody in town who had any kind of property, how many milch cows, how many taps, how many, it was a tangible property tax in a sense. I don't look for you.
I'm gonna have us go, we're wondering.
I'm getting
Yes.
back to something that you said.
Great.
So I'm gonna see if I get this right. 10% of all those who earn $1 million or more make it yearly. Otherwise, 90% of those who are making over $1 million are only making it one time.
I'm sorry, not necessarily one time,
Oh.
just not continuously. There's a bar graph in the last 10-year tax study where you can see it's around half or just making it one time or maybe a little more. And then you can kind of see the bar height for twice or 3 times or 4 times, but it's, lower. That makes sense.
So, so do you want to, is there a caution there?
Pardon?
What should we be, what are the pros and cons of that?
The pros and cons, to me, if there's this very high marginal rate, the risk probably is to the 130 or so who make the over $1 million a year after year. They're probably more likely to do something than the one-time event people.
Let's go on to
Okay,
the
so,
VIP tax.
I know Pat and Kirby talked about this morning. So what the committee is looking at is what ITEP calls the enhanced, investment proceeds tax or wealth proceeds. And basically capital gains would make up the bulk of it, 69%. And Kirby and Pat talked about what capital gains are. I think this committee knows pretty well. At the federal level, short-term gains are taxed like normal income. Long-term gains get lower rates based on the person's income. The reason they do that is for 2 reasons: to encourage investment, and because there's no, you can't bump up your gain based on inflation. So that's why they tax at a lower rate. In Vermont, I'm going to talk about it on my next slide. We tax capital gains normally, but some long-term gains are eligible for a 40% exclusion. Dividends are profits distributed to shareholders of corporations. And at the federal level, qualified dividends get those same rates as capital gains that I just mentioned. Ordinary dividends are taxed like normal income. All dividends in Vermont are already taxed normally. All our regular rates apply. Rents, royalties, and trusts. What the NIT at the federal level does is it double tax. It's a surtax on passive income for this, and so it takes those that are already taxed normally and it applies an extra 3.8, I think it is, percent. And then in Vermont, we're already taxing it normally. Interest, same as the one above. It just adds a surtax, and Vermont is already taxing it, interest. And then non-qualified annuities are these complicated things. It's like an annuity that you buy with after-tax income, like a Roth IRA, and the portion of the gain is already taxed normally, both federally and Vermont. So this is all to say that this money is already taxed. So it's not like the Vermont wealth proceeds or investment proceeds is catching some loophole. It's not about a loophole. It's about a surtax on certain types of income. So quickly, we do have this 40% capital gains exclusion in Vermont, and the question is why? Why would Vermont do that? And helpfully, there is a statutory purpose we can look at. It exists to help mitigate the impact of one-time realizations in a progressive tax structure. So that's saying, hey, you've been roasting coffee, building your own business for 9 years. You made $75,000 a year for all that time, and then you sell it to a regional fine food distributor for $2 million. You sell your coffee roasting business. In the year that you realize that big gain, we're not going to snag you with our high rates. We're going to give you like an acknowledgement that it is a one-time event. So that's why the 40% capital gains exclusion exists. It applies basically to the sale of farms and businesses. And like, if you're selling a bunch of stock, you're not eligible for that. Oh, I have it right here. Filers can deduct 40% of the gain from assets held longer than 3 years, except not real estate, not depreciable personal property, and no stocks or bonds. And it also can't be more than 40% of federal taxable income, and it also, as of a few years ago, can't be more than $350,000.
Representative.
With respect to this, and I'm not saying we should do this, but I'm just curious, do any states, we have current use, we have a variety of programs that reduce people's tax liabilities. Some of them are on properties that are quite valuable. And when those are sold, let's say someone passes away and they have a $10 million home. Does anyone ever acquire any of that? Like,
Can't think of anything like that offhand.
We talked about that, you brought a proposal.
Yeah.
Did you brought a proposal?
It was very unpopular.
Yeah.
Yes.
But that was something that other states do that's sort of like that, right?
Yes. Yeah. Yeah, so that's a tax deferral. That's like helping older people stay in their homes. Oregon has a tax deferral program where you can, you're an older person, your kids have moved out, you can stay in your house, you can defer some of the taxes. But then when you sell it or pass away, then the taxes come due. Which is, I think it's good, and Maine now has the same thing. In fact, 30-something states have that. But I don't know, to your question about current use, I
That's
don't
actually
know.
kind of cool. I was trying to think of an example like that, deferred taxes. I mean, I do think that's interesting to know if 30 other states are doing it.
I think
That's one of the reasons that.
we spent a long time talking about it last year,
Yeah, that's here.
and none of us liked it. I remember you first told us about it downstairs, I think.
This is one of the reasons, I mean, when you kind of say, what are you doing to help older Vermonters, how are you looking this or that? Part of the population, I think it would be great to have in the tax setting how we're helping different parts of the population. Like how we help somebody with children, how we help somebody with this particular kind of income, how we help people for older Vermonters.
I appreciate that. I think we're going,
I know,
off
but
topic
I'm
here.
afraid that since I didn't hear, yes, we're going to do that, I thought I would
Okay, will you
count.
write it down or something and we can, while we say.
All right.
Okay, so that last slide about the capital gains exclusion is pretty important. It's gonna come up again. But first, we're gonna go over who's benefiting from those tax changes. The OBBA. Generally, the personal income tax provisions help low and middle income filers. There's not a material change for the high income filers compared to the last 8 years. The General Assembly reacted to the TCJA 8 years ago by increasing taxes on high income filers in Act 11. We talked about this for a minute. Vermont's income taxes are already among the highest in the country, and the proposal would make it make us number one. Some maybe high profile filers may actually physically move away, but generally, importantly, if you tax income more, you get less income. If you tax sheep more, you get less sheep. If you tax whatever more, you get less of it. So the surcharge or the investment proceeds tax, it may raise some revenue, but it will cost on the personal income tax side. People will make behavioral responses that will jeopardize the main personal income tax to the general fund. And when we talked about this, the investment proceeds tax would tax an assortment of income streams that are already fully taxed in Vermont, with the exception of that capital gains thing. Long-term capital gains would make up a large portion of the tax base for the new surtax, while simultaneously getting preferential treatment under Vermont's personal income tax code. And I put a sad face there because that's super weird to have in your tax code a place where a type of income gets special favorable treatment and then another spot where it gets punitive treatment. That's super, super weird.
Talking about the 40% exclusion for capital gains.
Yeah, so saying like you built up your business, you sold your coffee roasting business, we're giving you 40% capital gains exclusion. But wait a second, turn the page in your income tax booklet. you owe an extra 4% on that. That is sad face. So I'd put a sad face on.
Agreed, it is weird, yes.
So, and I was thinking regarding.
You know, realize Jake just proposed we remove the capital gains exclusion. which is-
No, I think the capital gains.
Yeah, I'm kidding, I'm kidding.
Nobody said that.
I am kidding. I'm sorry, Carol.
You got the attention around here.
But what I'm thinking about is what you were saying in number. Where if you tax income or you get less income, is if we want stability in taxes. And I wonder if it's better to choose stability in income taxes. Or I don't know if you can have stability in this, in the other tax we're talking about. That investment income, so I wonder if you're really better off. Having the stability come from. Having stability in the income tax and not having all this going on.
So if you think about the Vermont's income tax, like for people like me, you know, it's very stable. Like I work every day. I don't have exotic income. The instability is at the top with capital gains. And this investment proceeds kind of hooks on to that. It has the same instability. Actually, the ITEP report has a really good discussion of the instability and how to deal with that. And so you could take a look at that and then ask whoever is coming from ITEP tomorrow. But you're right that this investment proceeds tax would have some of that same instability as the capital gains part of regular income taxes.
So if you had to choose, would you rather have stability in the income tax or deal with this other investment proceeds tax? I'm feeling like I'm hearing, but tell me if I'm not, then you're better off with a stable income tax, not pushing the income into the debt. Not fooling around with investment proceeds.
I think if you were to enact the investment proceeds tax, you'd have to be really cautious with how you use it. Because if you're looking for something that needs $40 million or whatever, it may not get you that. It may be very bouncy.
Yeah.
So it's like, yeah, it's, I don't know, that's a consideration for you.
Okay. Thank you. That's what I was thinking.
So first off, I find the sad face and the phrase exotic income very charming.
Oh, thank you.
Also think of
That
that.
was good.
So it's one piece. Now, with all due respect, I find the statement that low and middle income filers generally are benefiting from the OBBA generally to be pretty disingenuous.
Okay.
When you look at the total in dollars, when you look at the total amount of tax cuts that were part of OBBA, 71% of those dollars are going to the top 20% of earners nationally. So while there may be more provisions in terms of number of different kinds of tax cuts that are benefiting folks like myself who work for tips, more than 70% of the total dollars in tax cuts are going to the wealthiest 20%. So to say that low and middle income filers are generally the ones who are benefiting from the OBBA, I find to be a bit of a stretch.
Well, I was careful with my wording. I said tax changes. So to me, the tax changes are the things that are new in the one big beautiful act. I don't disagree with the
Yeah, fair
statistics on who's benefiting from extending the lower rates. I think the statistics are all right. It's just that what's actually changing in the OBBA versus 2024. And, you know, it's mostly the things on my slide.
Yeah, fair.
So, and also Pat or Kirby mentioned, the only other state that has a tax like this is Minnesota. The rate is 1%. And it only applies to investment income over $1 million. And they are getting half of the revenue that they expected from it.
Do they know why?
Yeah. I mean, they sent me a long email. I read it quickly before this committee started. It sounded to me like partly like a math mistake. But it also, they think that just in the first year of a new tax, there's not good compliance. So they think that people just didn't really know about it. But anyway, so yeah, Minnesota is the only one that does it. And they only do it if you have $1 million of this kind of passive income.
How, in terms of like, so there's exotic income sources and then there's sort of exotic tax rates. How would it be for tax doing sort of this type of tax that's really closely aligned with the federal tax compared to some different creation on our part?
Well, I
Like
mean,
in terms of a compliance.
yeah, so the closer it is to the federal tax, the easier it is to administer. If, you know, if a bill was passed that said your Vermont investment proceeds tax is just half of whatever you paid federally, then that's incredibly simple, right? But the problem is there's gonna be differences on what you want to include and exclude it from the tax base. And those definitions are gonna get quite complicated. Like Minnesota said, hey, sale of a farm, we don't want to tax it. So they had to write that in. And I imagine that this, you know, body may also not want to include the sale of a farm. So then it starts getting complicated, and where it gets really complicated is if the feds get rid of their net investment income tax. Then Vermont would have to
It's on.
do something just breathtakingly complicated to bring it back. I think, well, you may want to ask Tribute about that one, but that's my opinion.
Yeah, we learned a few years ago that, the income, personal income going high and low for various years. If there's a family business that sold 1 year, there'll be very high income for that family that year, but then that's a one-time event in many cases, so that's why President Ansel referred to the income swings as lumps.
Yeah, and that's most of high income in Vermont. It's of that nature.
I know you say here that some high profile filers may physically move away. I don't know all the details of New York, but it sounds like, you know, the governor there is saying that she made a mistake and she'd like folks to come back to the tune of, you know, I mean, she's saying in here, I don't know how she can figure this out, $13 billion in lost revenue from high net worth, you know, earners. So what's the difference there, I guess? Just bigger states or?
I mean, New York's probably got a lot of high rollers. I don't know who moved out of New York. I know New Jersey, there were some high profile people who moved out. California, right now, there are a lot of people moving out of, not a lot, a handful of high profile people moving out of California because they're thinking about doing a wealth tax. So yeah, New York has a lot of higher wealth people. I don't know how many Vermont has really. I know how many high income filers you have, but don't, yeah,
What else do you have here for us?
I think that's all.
Thanks. Thanks for coming in, Jake. Oh, yep.
I know obviously the data is highly sensitive, but do you ever have like an aggregate map of where high income earners are located?
Knowledge.
We actually do know a lot because we have a bunch of business owners, we got a lot of surgeons. The reality. I'm guessing it is, but it's also.
It's not Newport.
It's not Newport.
Let's let Jake answer the question, team, rather than teasing each other about our districts.
Kind of imagine a map, because if it had individual points, that would be like a confidentiality problem.
Yeah, that's what. I'm-
So you need kind of like shades of, or blobs or something, so that you couldn't
Like a
tell.
big circle that shows that
Big
there's some here
circle.
and there's some here.
Yeah, we never made that map. But if you go to our annual income tax statistics, there is data by town, and you might be able to get a sense of it from that. Yeah,
At some point, I need to walk an envelope over to the tax department right now.
Wow, you really wait until the
What would that be, Jim?
final moments on tax day, Mr. Maslin.
I'm open to those things.
Do you want to just give it to Jake to deliver? I'm just kidding. Terrible idea. Okay. Jake, thank you very much for joining us. Really appreciate your work and help always. Folks, we are done for the,
Well,
hi, can I just have your attention just for one more second? Jim, just one second. Want to make sure you have time to go to the tax department. we're done for the day. I'll see everyone tomorrow at 9. Thanks so much.
Thank you.